Thank you so much for the invitation to be here, and thanks to all of you for coming. And boy, I mean, there are two things that kind of hit me. One is, did we pick a particular good week to talk about politics, right? And the second thing is, I don't want to be misleading. He just introduced me as somebody who worked at the White House. I did, but not in the capacity that you might think. So I was not a political guy or something like that. No, I just happened to translate. So I was not using my own words as somebody else's, but it was an amazing experience. And I'm not going to tap into that at all to talk about what I'm going to talk about today. So with that being said, let's dive right in. I love for this to be more engaging and interacting than just the monologue. So anytime you have any questions, thoughts, please go ahead and throw them out there. And I also realized that this topic of politics, it is, particularly these days, deeply emotional to many people. How do you feel about politics these days?
Deeply emotional.
Deeply emotional. I have a 16-year-old, and about a week ago, he made this comment that he hasn't been around that long, but he noticed something different about the environment these days, that somehow it's so emotional that bonds between people are kind of broken a bit. Like, there's argument within families, there's argument between friends, and that's something that he had noticed, and it was a pretty, I thought it was a pretty accurate description of what I've seen at all. And I personally think that it is incredibly emotional because it touches on our core beliefs, it touches on values that we hold, and I'm not here to talk about that emotional side. Because I also want to be careful. I want to respect everybody's views. I have my own view, and I'm not going to talk at all about this. I'm not going to forecast the politics. What I want to do is actually something different. What I like to do is disentangle all the emotions that come from politics and talk about something that really matters, which is your money. How is politics relating to your money, to investments in the stock market? That's the question. It's not whether or not it makes you feel good or bad. It's like, how is politics impacting your money? That's the main question of the day. So it's, if you are a blue or a red, I'm not here to make you feel good or bad. I'm just here to disentangle that emotion. I'm going to tell you, that's the hardest thing for people to do. Because sometimes you get so emotionally attached that, not just you, but I think everybody, that it's harder to pull back and get some perspective. And that's what I like to do, is put some perspective on politics as it relates to the stock market. And there are two questions that we have looked at, and the ones that I want to discuss with you today. The first one is, we've studied this a lot. And the question is, how is politics intertwined with the stock market? What's the connection there? Looking back at history, is there some inference that you can make between politics and the stock market in a way that would lead you to make a decision about your money? That's the first question. How are politics, and when you look at the evidence and the data, is there a connection there between politics and the stock market? Make sense? Would you be curious about that? Because you like to know, the elections, how is it impacting my money? Should I be doing something in response to one president or potential president or the other? The second question, which is more fundamental, is looking at this, why? Why is it that we see what we see? Why is it that the politics matters or not when it comes to elections? Because that's the fundamental question. It's not just like, it's related or not, but why? What's the underlying cause? Because once you understand that would help you make better decisions with your money. So my goal is to give you some perspective and ultimately with these perspectives to be more well informed about what is it that you need to do with your money. What's the best choice to do with your money, irrespective of who is winning the election later this year. Make sense? All right, so let's start with the first question. And we've looked at this in depth. Does it really matter whether the presidential election that year creates more uncertainty in the market and you see the results going one way or another? When we looked at all this over the years, and we can go back to 1926, there are two ways that you can measure the performance of the U.S. stock market. The first one is what most people put up on the news. What's the one thing that defines the U.S. market on the news? Dow Jones. Dow Jones is one way that you can look and see how is a group of companies in the U.S. economy doing. And how many companies are in the Dow Jones? 30 companies. How many companies can you buy and sell in the U.S. stock market today? About 3,000 different companies that trade on a regular basis. So somehow this, Charles Dow back in the 1880s decided that he's going to select a subset. Initially there were 12 companies, and now there are 30. They're supposed to represent the entire stock market. What do you think about that? That's the popular media. And by the way, what's the one big company that we all get boxes every day, but it's not in the Dow Jones? Amazon. How can you consider the U.S. market without looking at Amazon and saying Amazon is part of it? The better measure, the one that I'm going to use for the stock market, was created a long time ago when Standard Statistics merged with Poor's Publishing, and they formed Standards & Poor's. And initially it started with a lower number of companies. Right now there are 500 U.S. companies, the largest, most representative companies in the U.S. economy. Still a subset, but a pretty large subset. And those companies form what's called the S&P 500. And that is a broader measure of the U.S. market, and that's what I'm going to use to measure how did the market do. When I say how did the market do, I'm not talking about Dow, because it's a smaller subset, but more the S&P 500. So let's look at this. Historically, going back to 1920s, anytime you go past 20 years, what do you think the U.S. market returned to investors on average per year in terms of its growth? On average per year. Whether you look at 90 plus years or you look the last 30 years, it's pretty much very consistent. Any guesses? 7, 8, 9, 4. I'll tell you, the real estate in San Diego has been about 6 to 7%. Minus the headaches, or plus the headaches, whatever. The U.S. stock market has returned about 9 to 10% on average per year, which is a really nice growth to grow your money on average 9 to 10% per year. And I'm going to come back to this. Now, if you now look specifically at the years when we had elections, what do you think the average was in the years of those elections? And we can go back to the 1920s. How do you think that average in those years compares to 10%? Is it higher or lower? Higher, lower? It's all over the place, right? Well, it turns out that it's exactly pretty much the average. The election years made no difference. If you look at the average of the election years, it's pretty much spot on the historical average. So from that perspective, having an election year doesn't make any difference. It's the same average as we've had before. But again, looking back to the 1920s, with all the elections that we've had, how many years in which we had elections did the market drop in the year of the election?
Just one because of the depression.
None? 3. Out of all the years with elections, we had 3 years when the market dropped during the election. And I'll give you those 3 years. And you tell me if you believe that drop was caused by the election or some other event. The first one, 1940. What do you think mattered? Yeah. I mean, you had the Europe being invaded. Was that a major reason, or was it the election? The war. The next time in an election year when we saw the market drop, it was in 2000. What do you think caused it? Was it the election, or was it pets.com? I mean, you tell me, like, is that the election the cause of the downturn? And what's the third one? Everybody should know it. 2008. Was it because of the election or the great financial crisis that had been brewing for years and years? So when you look at the evidence and you ask, in the election year, should I be doing something? The answer to me, it's not obvious that he should be doing anything, because it's not vastly different than anything else. That's my first contention, that election years are nothing special. The only down years have been driven by other events than who got elected in office. That's kind of the first thing that I looked at. The second thing that I wanted to see is, if you look at the different presidents, and some of them being more business-friendly than others, does it make a difference in terms of the returns of the U.S. market during the time that they were in office? And we can go back. I'm not going to go back to the 20s, as the slide would have been too busy, but I'm going to start back in the 1960s, because that's when I was born. Actually, 69. So when Nixon was president, the market, the U.S. market, on average, lost almost 3% per year. That was during his year. But you also had the Cuban Missile Crisis. You had other things going on. Who was next? A little trivia? No, Ford. Took over for a little bit. Well, again, same Republican president, instead of negative 3%, it was plus 20%. That was the average per year during the time they was in office. You fast forward, Jimmy Carter, our friend from the South, 11% per year, a little above the historical average in his 4 years in office. And then following that, Reagan, which is a great track record. But after Reagan, who came after Reagan? It's a history lesson, along with investments. George W. Bush, 13.9%, really good. And next? Clinton. The question that I have for you, I mean, this is 20% per year on average during his tenure. And then who followed him? Negative 4% on average per year. Here's a question. Do you think that Bill Clinton should receive credit for the tech boom and the fact that he left office exactly before it burst? Do you think that George W. Bush should be discredited for market performance because he walked in right as the bubble burst and 9/11, and he left the office exactly at the bottom of the market, of the crisis? Is it because of them? No. And afterwards, Obama, President Obama, 15% per year. In what many people thought that this is not a very business-friendly president. And then the last 3 years, very similar, about 15% per year. So to me, when I look at this, is there evidence that whether you have one party in power or the other, that it really matters, and you should make a decision about your money based on who gets elected, being Republican or Democrat? It doesn't seem to me. It seems to me that this is not really the affiliation of the person in power. It doesn't seem to me, again, looking at the election years, looking at how historically these numbers played out, it doesn't scream to me that you should make a decision with your money one way or another based only on the political affiliation of who might be in the White House. The truth is that if you look historically, whether you can go back to the 1920s, what we did see is that through Republican and Democrats, the market has been going up and up and up. That's the one thing that's consistent. It goes up and up irrespective of who is in the office. So that's the question. So my first contention to you is that when you look at politics, do not get carried away, because the U.S. stock market is not driven by who is in the White House. It is not. It doesn't have as much impact as you think. Whether it's an election year or the whole presidency, it doesn't seem to have an impact. The question now is why? That's the better question. Why is it that this is not the case? So I want to offer three reasons that I particularly found for just as I try to find this for myself. I was curious about myself. Why is it that this doesn't matter? And I'm going to start with the fundamental question. When we're talking about a stock, what exactly is a stock? Because you hear the stock market all the time. It's taking a breather. As if it went for a run, it's kind of a little tired. It's not a living, breathing organism. What is a stock market? It's basically a conglomerate, an aggregation of all these companies, all these stocks. But let's again look at what is a stock, because it's a fundamental piece. And I'm going to go back to a story that I got asked. My 16-year-old, he's a pretty bright kid, and my brother-in-law he finances movies, and one of the movies that he made was Ocean's 13, or one of those. Not very good, but but in one of those there was a challenge, and the challenge was to steal the very first stock certificate. That was what they were supposed to steal. And my son asked me, well, what was that certificate? I had no idea. And he made me look and dig into it, and it's a fascinating story. The very first modern stock, the basis on which we have the stock market today, Anybody knows what that stock was? I got to tell you, I did not know, and I was surprised to hear what it was. It's way before, not quote way, but it's before that. It is the most brilliant people that I know, because they set up modern stocks the way we have them today. And it started in the late 1500s with Vasco da Gama, ended up charting the way to the Indies. And the Spaniards and the Portuguese would bring back merchandise and the spices and all this, but they were not the merchants. And don't say the merchants were in Venice. That's a play. Anybody knows who the merchants were? The Dutch. The Dutch were incredibly smart. And they were the merchants, and they would take the merchandise and they would distribute it. And as merchants, at some point they said, well, why are we paying the middlemen? Why can't we send our own ships and then we make all the money? Which is pretty logical. And a few of them put the money together and they sent some ships. The problem is back in those days, there was no GPS. You had pirates, you had weather. Ships wouldn't come back and they would lose their shirt. And they came up with this brilliant idea that they would set up a company unlike any other one that ever existed up until that point. And to this day, by the way, it is the largest company that ever existed on Earth for 200 years. Anybody knows what the company is? It is called, what's called the Dutch East India Company, also known as VOC. And they were brilliant in some ways. They were the very first company that they said, okay, we will, instead of just us participating, we need scale. So we will offer ownership to anybody in society who wants to come and participate. So they said, if you want to be a part owner, you buy ownership in the company, and based on your percentage of ownership, you will get a percentage of the profits. That's exactly how it works today. If you buy Apple or Google or Qualcomm, whatever you buy, you own a piece of that company, and based on that portion of ownership, you are entitled to part of the profits. That's what you're basically buying. You're buying part of the profits that the company makes. There was the very first thing that they said that was brilliant. The second thing that they did, they said, we're going to separate the liability of the company from the liability of the shareholder. In other words, today, if you own Samsung stock, nobody's going to come sue you because their phones exploded. And the third element that was brilliant, they said, if you do not want to wait for these profits to trickle in for years and years to come, because this company will last in perpetuity, doesn't have an end date, if you don't want to wait, then you have to go find some other member in society, and you have to decide at which price you exchange ownership, and that person will now take the ownership and receive the profits. And the very first stock market that ever existed in the world on modern basis was the Amsterdam Stock Exchange, set up in 1602 to trade that one stock, Dutch East India Company. But think about it. Everything is exactly the way that those people set it up today. When you buy shares of a company, you're buying profits for years and years to come until you exchange it on the stock market with some other market participant, not with the company itself, and you have to decide on the price. And then you get to receive those profits for as long as the company exists and you own the shares. So it's exactly how it is today. And why do I bring this up? Because if you think about what I just said, the way that the markets work today, there are three things that I'm going to suggest to you are the reason why elections and presidents might not matter as much as you think. Number one, if you think of Dutch East India Company, if you think of Google, Qualcomm, what do you think matters most? Who's in the White House? Or products they make? The strategy they have? How they execute the strategies? What competitors do? What do you think matters most in terms of the profits? Because you're buying profits for that company. What do you think matters most? The company and what they do themselves. That's kind of what matters. So yeah, who's in the White House might impact this on the margin, but not really as much as you think. The second thing, so it's you basically, the strategy of the company matters a lot more in terms of profits than who's in the White House for most companies. The second thing is, how long do you receive these profits? Let's take companies, not Dutch East India Company paid profits back to shareholders for over 200 years. So if you bought it back in 1602, for a long time, you would have gotten paid. Is there a company today that you can think of that might have had such a long track record? Not General Motors, before that. Exxon. If you bought a share of Exxon in the 1880s, even today, you would receive in your piggy bank part of the profits. 160, 130 years or so, you still get the money. It's a very long-term proposition. So if you think about how many years you get to receive profits, how much do you think the next 4, 6, or 8 years matter out of 100+ years that you might get? Is it a lot or a little? It's not. It's a very long-term proposition. Mathematically, when we did this, I remember doing this in my first year of PhD. It was basically about 5% of the company's value that might be over the next 8 years. It's just mathematics. It's just pure math. What matters is the long term a lot more than the next 1 or 3 or 5 years. But the last reason is the one that I'm fundamentally the most fond of. And it's an interesting one. And again, not getting to politics. And I was telling my friend Chris this story in the car. I happened to do an event like this with investors in Santa Fe, New Mexico, which is a very liberal town. I had no idea. It's my first time going to Santa Fe, New Mexico. Anybody's been there? Pretty little place, yeah. And it was a luncheon, and it was the day after the election. And it was a pretty tense. And long story, I don't want to get into the whole thing, but one of the things that people are afraid is well, what if we get into a situation where it gets wars-like and we have other big crises in our hands? What should we expect from the stock market? And it was very early, it was the day after the elections. Come on, it's a little early, but it was an interesting question, and it got me thinking. The reason that I'm optimistic is, in my mind, was that not that I have a blind faith, but rather I really believe in this idea of free markets and this idea that in this capitalist world that we live in, all these companies will try to find a way to make money in whatever state of the world we're in. How many of you are business owners? If you're a business owner, what's one of the main goals that you have? Make money. That's one of the purposes. These folks, when he looks at the fiduciary role to the shareholders, is there to make money. All these companies are there to make money. And they will try to find a way to make money in whatever state of the world. And what's been really even fascinating in the last few days thinking about this, yesterday I was in Hawaii and with my daughter. I have a 16-year-old son and my 12-year-old daughter. And we rented a Wrangler, a Jeep. And anybody has a Jeep? It's actually a really fun car. She really wants one. But on the handle, on the passenger side, it said something right there. Since 1941. You remember that? 1941. And I didn't quite pay attention. It was great for them but then it got me thinking, 1941, who started making cars in 1941? And then it kind of got me thinking, wait, why 1941? It's a war. So just out of curiosity, I ended up kind of going back and we have a big book of numbers that Chris is in the back. And I looked a bit at that period. And it's quite fascinating, and it's a lesson for all of us today. 1937. I'm not exactly sure why, but the stock market dropped by approximately the same amount that it dropped in 2008. It lost 37% of its value in 1937. 1938 rebounded a bit, but guess what? 1939 lost money again, and that's when you had the Germans invading Poland. And then you had 1940, which the market was down again, and at the end of 1940, we get into the war. Picture yourself, 1940, Pearl Harbor happens. You are now looking at, 1937 was an incredibly bad year. We're now in a war. How would you feel as an investor back then? Put yourself in those shoes. What would your gut reaction be about the market? Huh? Very cautious. That's kind of how I feel. Like, why would I ever want to touch this? There are all these people dying all over the world. There's no markets. It just doesn't seem like it's going to go well. Just for kicks today at lunch, I was looking at what did the U.S. stock market do 1941 to 1945, the 5 years that were in the war. Did it lose money, make money? And Chris and Ken and I were like, well, I don't know. We looked at the numbers. Anybody guesses what the market did in 1941? It's, again, the average is about 10% per year. Do you think it made more or less? How much do you think it lost versus how much do you think it made? More. If the average return is 10% per year in the U.S. market, during the war, the U.S. stock market returned on average 17% per year. In other words, if you put $1 into January 1st, 1941, by the time the war is over in 1945, you would have more than doubled that in the U.S. stock market during the darkest days of our parents' generation, our parents' years. And for a minute, I thought, why? How come? And then it was kind of pretty obvious. If they cannot sell cars, what will they make? Tanks. If they can sell toys, they'll make bullets. They'll find a way to make money. That's what I'm banking on. Whatever state of the world, these companies will find a way to make money. And that's what my optimism comes from. As long as they're allowed to operate freely, they will find a way to make money. And we are all along for the ride. It's the one stake that we have in capitalism. Just having a stake in capitalism. And when these folks go to work at Qualcomm and wherever they go to work, you should say thank you because they all work for you. As long as you have Qualcomm in your portfolio, they're going to work and they make you money for you. And you don't have to participate in the day-to-day business. That's the beauty of the stock market. And that's why I don't, whatever state of the world, these folks will find a way to make money. And that's kind of what the optimism for me is. So, to me, those are the two main kind of conclusions. The first one is that stock market and politics, they don't interact as much as you think. It's much more about the company themselves and their desire to make money. It's a very long-term proposition. And to me, I would not make any decisions based on politics, elections, because that's not the main driver of the stock market. It's a lot more complicated than that. Yes? Absolutely. Uh-huh. So Steve's comment was that perhaps is not just necessarily the companies looking to make money, but it's the government spending money. It's the deficits that are caused by all the spending that the government does. But to me, in a way, that's a form of how the company. You're right. I mean, it's a combination of a lot of factors. So for sure that the government spending has. I think that the government spending is a way that these companies can participate in and make money. And I think that they adapt. I mean, I think that ultimately companies adapt.
I guess that's it.
Yeah, so Steve's comment is absolutely right. So in times when you do have big situations like this, it is absolutely possible that you have not necessarily the consumers buying products, but it could be that the government picking up the slack and they're purchasing, which is absolutely true. There are three main spenders in the economy. One is the consumers, the second is the businesses with investment in their business, and the third is the government. At any point in time, any one of these can step up more or less. Right now, the consumers are basically carrying the U.S. economy. There are times when the investment in companies was carrying a lot more, and sometimes the government. So one of the three tends to carry the day. But historically, I'm not many times when all three of them, maybe the Great Depression, all three of them, the consumers start spending less, and the government, and maybe investment. I can think of though, like even in 2008, the bottom of the U.S. market. Do you remember people lining up to buy very expensive products? I do. I was one of the idiots. Yeah, he bought a house. That was a good time to buy. I remember like seeing pictures of people lining up to spend $1,000 to buy an iPhone. No, not just lines, but around the block lines. I mean, there are pictures all over the world of people lining up in the bottom of the Depression. Do you remember those days? What happened to those days? Nobody's lining up anymore. But it's possible. Yeah, absolutely. There are three different legs to the stool, and each one of them can contribute. But maybe to kind of wrap up a little bit, the ultimate question, though, when you look at elections and when you look at your money, nobody wants to lose money. You want to keep your money safe. You want to be protected in your investment, right? That's ultimately what you're asking. It's like, politics, willy-nilly, but I don't want to lose money, whether it's election or something else. How do you go and protect your portfolio against losing money? Would that be a fair question? That's the question behind the question? Yeah. There are two very distinct ways, two different narratives onto how to do that. And I'll give you both, and you tell me whatever you think it's more appropriate. I'll also give you my perspective, but I want you to understand both. The first way that people have tried to protect their money, and this is exactly where I started when I was in the PhD and I started having some money. The notion that there is a good time to be invested, and there's a time when you should sit on the sidelines, wait for the market to do what it does, and then come back in the market at the right time. Timing. That's called exactly, it's called market timing. If you hear this term, market timing. And it is intuitively very appealing. Why would you want to, if you see the train coming on the tracks, well, get out of the way. You don't need to stand there to get hit. Have anybody thought that that's a good strategy? Anybody? I did it. I mean, I thought it makes sense, intuitive sense. Why would I want to, everybody's telling me the market's too high or there's something bad about to happen. Why do I want to stay invested? And I looked at this, and back in those days, I had really good professors. I had good data. I had computers. I had papers that I read. And I started developing a more rigorous way to decide when it's time to get out of the market. And I've done it several times in my life with my own money. And there are three lessons that I've learned that maybe it's worth sharing with all of you. The first lesson that I learned is that whenever you decide you want to step out of the market, for whatever reason, it's too high, it's too choppy, there are elections, whatever reason it is, you have to make a second decision at exactly the same time. If you decide you want to get out today, there's an equally important decision that you have to make at exactly the same time. What do you think it is? When to get back in. Every time I did this, I would wonder, when do I get back in? If 20,000 is too high for the Dow, whatever's on the news, what is the right number? Is it 26, 25, 27? What if it never gets there? And in my case, what I found is that I ended up losing more money because I missed the upside than I was able to protect the downside. I didn't know when to get back in. And at so many client events the last few years, I have had people as late as like 3 years ago coming and asking me, I've avoided part of the downturn in 08, 09. When should I get back in the market? And I was like, what do I tell these folks? I mean, it was much more of an emotional, behavioral issue than anything else. The second thing that I learned is that if you don't make that consecutive decision, the stress of being invested in the market is very, 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 very quickly replaced by the stress of being out of the market. Because now you look at it and you see the market's going up and up and up, and I'm sitting in cash and I'm losing all this. And in my case, I blame myself. I was so dumb to get out, and it was my decision. All I had to do was stay put. And it was very stressful because I did miss some big upsides. Anybody here has done that? It was hard. It was really hard. So don't think that if you sell because of whatever reason, you're going to have peace and your mind's going to be at peace. No, because you're going to see the market going up and you're going to wonder, when do I get back in? But there's a third reason that really convinced me that maybe for me it's not the right strategy. And it had to do with when I talked to my professor about this, and I was telling him, how come I'm consistently losing money? I can't be that dumb. I'm getting a PhD. Hopefully one day I'll handle people's money. Like, why? And there was a quick statistic that stuck with me over the years that I thought it was very helpful for me. And it had to do with this concept that he planted in my head, and which I'm hoping that I can convey to you too. That whether it's about investing or life in general, I don't think we can have certainty and guarantees. But really smart investors don't look at investing about certainty and guarantees, but much more about understanding odds, statistics, and probabilities. Smart investing is not about certainty, but understanding the odds. And in fact, life in general. We're talking in the car today. When I was younger, I used to smoke, and I used to be quite unhealthy. And years ago, I decided to change, and now I don't smoke anymore. I still have some vices, but I eat healthier, and I work out every once in a while. Does that guarantee me, or anybody who does this, a longer lasting, healthier life? Is there a guarantee somewhere?
No guarantee.
No guarantee. Of course something can happen. Knock on wood. But what does it do? Why do people do it? It improves your odds. It's all about the odds. That's what this is all about. It's all, I mean, you can look at, Cliff Richards or the Rolling Stones, and they're still like smoking and doing it. You can do that, and you can say, well, I want to be like him. But, for every one of the Cliff Richards, like 50 people who just don't make it. So to me, like, it's understanding the odds and statistics. So here's what this is why I think it's moving in and out. It's not a good idea from that perspective. If you look at the U.S. market, and you can go on yahoo.com, on any of the websites, and you say, on a daily basis, I watch the market every day, every single day. What do you think the split is between good days when the market goes up versus bad days when it goes down?
50-50.
50-50? Yep. It's actually very close to that. Whether you look at 2018 or the last few years, and in general, it's pretty true. It's actually not quite 50-50. It's 53% of all trading days in the market are positive. 47% of the time, they're negative. If you stay out of the market for one day, is it obvious that you make or lose money? Obvious? No, I think it's more of a flip toss of a coin. It's not quite obvious to me. 53-47, it's almost like a 50-50. So on a daily basis, you're right, you have a little bit better odds to make money, but not crazy. In my case, because I had taxes and transaction costs, I did not stay out of the market for a day. So when you ask the same question, but now let's look on a monthly basis. When you look historically on a monthly basis, what you see is that 63% of all months in the market have been positive and 37% negative. It is possible that you get out of the market and you miss a bad month, you pat yourself on the back and you say, attaboy, you're so smart, you save money. But the reality is that month to month, it's pretty random. Market has no memory from day to day or month to month. Let's reframe the question. If you were to stay out of the market now for 1 month, what is it more likely for you to miss, a good month or a bad month? A good month. If you get out of the market, it's as if you go into a casino and you play a game where you lose 63% of the time. How smart is that? I wouldn't do that. That's what you're doing when you say, I'm going to get out. It's possible that you miss a bad one because about 37%, 1 in 3 or so, they are negative and you miss them. But your odds are a lot greater to miss a good one than a bad one. And the longer you wait, the worse it gets for you. Because when you repeat the same idea on an annual basis, boy, this is bad drawing. 75%, 3 in 4 years you make money, 1 in 4 years you don't. The longer you wait, the greater the chances that you'll miss something good rather than something bad. And that's, to me, is the key here. When I was moving in and out of the market, I was basically defeating myself because the odds were against me. It was stacked against me. I was being a casino player instead of being the casino house. The way you become the casino house is basically by staying invested and playing all the hands. That's the way you do it. You play all the hands at all times and you cover as many companies as you can. That's how you become the casino player, the casino house, until the odds of investing in your favor. So to me, this idea, even if it sounds appealing, it is not a very good way to go. So instead, over time, I've kind of developed a different way to think about protecting your money and protecting your portfolio that doesn't involve all this uncertainty. And it really starts with understanding what to expect if you're in the stock market. And it's 9 to 10% per year on average, but for the past 93 years, how many years do you think the market returned exactly its average? You have 93 data points. How many of them, how many years do you think it returned the average? Never. This is what it looks like from year to year. It's really choppy. I mean, that's the average, but don't expect it. And by the way, Chirag, one of the gentlemen in our office, came up with a statistic that I thought was really interesting. I don't know if you know the 2777. I know it's San Diego, it's not quite LA, but this is the lifetime average for LeBron James. 27 points per game, 7 rebounds, 7 assists. LeBron played over 1,000 games in his NBA career. Out of the 1,000 games in the NBA career, how many games did he achieve his actual average? 0. 0. Not a single game where he got his actual average. This is kind of what the market, just because you see the average, don't think that's what you're going to get every night or every day. So that's kind of the idea. But if you do stay invested, and my dad was born in 1926, if his parents, my grandparents, had put $1 in the market, not 10 or 100, one single dollar, what do you think this would be worth it by the end of last year? He turned 93 in September. What do you think $1 invested in the U.S. market, left alone through all the good times, bad times, would be worth by the end of last year? 1,000? 10,000? Millions? Ooh, Glenn, it's $1. All right, Chris has a book in the back that is a matrix book. It's my favorite book. So I think it's on page 15. What is the growth of that $1 invested in the S&P left alone to the end of last year?
That's a good memory. $7,025.
$7,000 or so. One single dollar in his lifetime. I wish my grandparents put $100, but that's a really nice growth. I don't know about you guys, but this is a really nice growth. $7,000 from $1 in his lifetime. That's really nice. That's a really nice growth in his lifetime. But 1 in 4 years you lose money. So you don't want to lose money. How do you protect yourself? Because I just told you that moving in and out is not the way to do it. Well, if that's not how you do it, there are 3 ways that you can accomplish that. The first way, which I think is the most robust, is not only to buy ownership in companies, because the profits of companies fluctuate, and because of that, the value of the company fluctuates. Instead, you can lend your money to corporations and the government. And there is a contract in place that for a specified period, they will pay you a specific interest rate, and at the end, they'll give you the money back. That is called a bond. A bond is very different than a stock, because in the case of a bond, you know exactly how much you're going to get for how long. And if they don't pay up, you can take them into bankruptcy. The safest of these types of investments is issued by the U.S. government. It is called a 30-day Treasury bill. You give the U.S. government your money. 30 days later, you get the money back plus interest. And if you had invested in these over the past 93 years, how many years do you think you'd have lost money? Never. Here's an investment that never loses money, very little fluctuation in value, but what's the catch? You never lose money. So if you don't want to lose money, here's an investment for you. It doesn't cost much to get at all, and you never lose money. But what's the catch? You don't make as much. So here's the thing. It does beat inflation. It does do better than inflation over the long run. So the average here in Treasury bills has been about 3 to 4% per year, which is a bit above inflation. So you do make money, but you just don't make 9 to 10%. You make 3 to 4%. And that's the thing. If you need the stability on your money, the best way, in my opinion, to get it is not to go to some fancy insurance products, not to go to all this craziness. Just look at bonds. Bonds give you this for very low cost. And in 93 years, the U.S. government has never defaulted. You never lost money. Never open a statement and you see, well, I have less money at the end of the year than I had at the beginning. But what's the catch? Again, 3-4%. And just to make it real, if you had invested the same dollar over the same time period in this investment at 3-4%, what do you think the same dollar growth would be instead of 7,000? 4,000? Chris, I think it's on page 53. It's the same exact dollar growth over the same time, now invested in these very stable bills, the 30-day Treasury bill. What's that number? $21. $21. What do you think? 7,000. You know, that's the fundamental trade-off in investing. If you want stability, you can get it. But also be careful, because too much safety is a dangerous place to be if you don't grow your money enough. And that's where an advisor comes in. For what you need to accomplish, what is the right mix between stocks and bonds is the most important decision. And there is no right answer. Only an advisor based on your specific goals, your circumstances, your pension or no pensions. All these things are what's going to drive that decision. But you have to be careful, because if you go in a fast lane, you know, it might not work out very well. But on the other hand, if you try to go on the bond side, that's also not going to work out very well. Yes, sir.
So in 2008, if your portfolio went down 37%, how many years would it take you to get back to where you were before?
So in 2008, if you had looked at this portfolio and lost money, how many years did it take to get back into this? So before I give you that answer, and very specific answer, there's a second way that you can protect yourself along with bonds. And Chris, can you mind? This is my colleague and my friend Chris. Do you mind bringing me that book up here? Because I love that book, and I love with it. I sleep with it. To give you the full answer is U.S. is not the only place where you can invest money. And it turns out that if you redraw a world map, not based on landmass, but the value of different companies that you can buy and sell, this is what the world looks like. I don't know if you guys can all see it. If not, it will be in the back. The U.S., when you add up the 3,000 companies in the U.S. that you can buy and sell, it amounts for about 54% of the value of all companies, meaning there are about 9,000 other companies in 43 other stock markets that you can buy. So one smart thing to do is not just buy U.S. companies, but really go around the world. And if you do this, what's fascinating is to look at how countries perform. Each country has a particular color, and I know you can't see the numbers. I can't either. Each color represents a country, and each column is a particular year. The best performing country is on the top, the worst is on the bottom. Question is, do you see a pattern that can tell you what the best performing country will be? What I can tell you is that for years and years, U.S. was here at the very bottom. And a lot of other countries did better and protected against U.S. losses. When the U.S. goes down, it is a good idea to have international companies, because they do hold you up when the U.S. is not doing very well. So the question was about our tax rates. Do tax rates matter relative to presidential elections or anything else? You know, in the 50s, anybody dares to guess what was the highest tax rate if you made over $200,000 at a time? 90+%. 90+%. Well, it was 200,000, which in today's dollars it would be. Yeah, I mean, tax rates. It's a little more complicated, because tax rates, there's so many deductions that didn't exist, and so it's a much more complex issue. By and large, what I can tell you is the investments don't tend to go along with the tax rates. And the best example is, there was one president in recent memory that I worked with who actually cut investment taxes substantially taxed the investment rates. Anybody knows who it was? George W. Bush. You remember the 15% tax cuts? Like dividends became 5%, 15%, long-term, it was a big tax cut. Did that help the stock market? No, it was a negative 4% over his tenure. So, you know, it's a little more complicated, but they're not really tied in together, because the ultimate factor is the company itself. Now, there was one set of tax rates that did matter, and the tax rates that did matter were the last round of tax cuts that you heard about, because the last round of tax cuts. First of all, I'm not sure about you folks, but I'm not sure why the word cuts is in that bill, because it feels like my taxes have gone up. I don't know about you guys, but that's kind of how I feel. But there was a big tax cut for corporations. So now the corporations got to keep more money that they can distribute back to shareholders. So what would happen to the value of the stock if you now distribute more? It goes up. So part of the reason that you saw the stock market bumping up over the last couple of years is that the companies now get to keep more of their profits, and because of that, their value goes up. Because after-tax money is what gets distributed to investors, and that's what you saw, is that these tax cuts had a positive impact on the stock market. So in that respect, there is an element of tax cuts that could impact the market. We looked at, so the question is, when you look outside of the politics and what we talked about, is there something that correlates to a good year or bad year in the market? Not on a particular year. So year by year, there's nothing there because there's so many events. Like we had an event this week that could have gone two ways. It could have been like a lot, one direction or another. Nobody really knows. What we did find is that when it comes to investing, there are some factors to which you should pay attention, but it's not necessarily a year by year. And it has to do with if you want to go beyond what the market does. You look at the S&P 500 and you say, well, S&P is one, I want to get the S&P. But if you say, how can I do better than the S&P? Is there a way that I can generate higher returns than the S&P? It turns out there is a way to do it. And that's kind of what we looked at. And that's what we've looked at for a long time, which is how do you increase your potential expected returns beyond the S&P? And it's not by looking year by year what the market does, but let me kind of do it justice. So if you look at the U.S. market and say, okay, I'm going to draw this box, and this box represents the entire U.S. stock market. All the stocks fit in this box. The question is there a way to do better than the S&P? And the answer is yes. The way to do that is by understanding that there are different types of stocks, and not all stocks are the same. The media categorizes stocks. What's the typical way that you define stocks on the news? Blue chip, you have technology, pharmaceuticals, all that. It turns out that doesn't really, that's a secondary consideration. But I'll give you the three major primary considerations if you're looking at analyzing stocks. And that's what makes a big difference. That's what we look at. The first one, which was discovered back in the late 70s, early 80s, that's when Dimension started. That was the pioneering kind of thing that we did, was this idea that the size of the company matters. And large companies is what you see in the Dow Jones and the S&P 500. But in the U.S. market, there are about 2,000 other companies that are part of the U.S. market, but they're not in the S&P and they're not in the Dow Jones. And those are called small companies or small caps. And what it means in terms of size is like, what's the value of the company? Everybody's familiar with McDonald's and Coca-Cola and Exxon and Microsoft and Google. But it turns out that, McDonald's exists, but there's also a Shake Shack. You have Shake Shacks around here? It's a smaller company. You have Bank of America, but also have Bank of Hawaii. And so there are all these smaller companies. And the idea here is that economically, these companies have a greater potential to grow in some ways. Because if you look at McDonald's and Shake Shack, which one can theoretically grow and double in size easier, McDonald's or Shake Shack? Shake Shack, right? But on the other hand, which one has a little bit more uncertainty attached to it because you don't have the maturity of the other one? Obviously, Shake Shack. So just think about this. If you got paid the same way, your money grows at the same rate, whether you invest in Shake Shack or McDonald's, where would you invest your money? If it grows the same way, Shake Shack and McDonald's. McDonald's. Why would you take the chance of the smaller one if you grow your money the same way? So these smaller companies have to give a bit of what's called a premium or kicker just for people to invest in them. Otherwise, they'll just go for the big ones. So I told you that $1 invested in the U.S. market over the long run was about $7,000. If you had invested the same dollar over the same time frame in the smaller group of companies, do you think you'd make more or less? More. How much? What's instead of 7,000? What's a guess? 14. Chris has that book. I think it's on page 37, if I remember. What's the growth of the same dollar in the 27,000. Same exact dollar, same exact time frame. The only difference is that instead of investing in the large, well-known jumbotron companies, you're putting the money into a larger group of these smaller companies, some that you've heard, some that you haven't. GNC, Columbia Sportswear, there are all these companies that are smaller, and historically they have given investors a higher return than the large ones. In the yes?
So you're talking about buying like an index fund.
Ah.
So you miss the companies that fail.
So the question is, am I talking about index and miss the companies that failed? Well, there are two very distinct ways that you can invest. And again, I'll give you both, and I'll come back to what I was talking about. The first one was pioneered in a way by Benjamin Graham and Warren Buffett, and this idea is that you cherry pick a handful of stocks and then you leave out everything else. That's called stock picking, which is you look at the universe, you decide which ones you like, and you analyze them and you buy some of them. And that's one way of doing it. I don't think this is the way forward. I think this is a little bit of Netflix, the blockbuster video in the age of Netflix, because it's not what it used to be. Why is that? Looking back at Dutch East India Company, what creates a competitive advantage when you go and trade with somebody else? Because you're trading with some other partner, it's some other party out there. What do you think creates competitive advantage? Information. Information gives somebody a competitive advantage. How long do you think it took for information to get to investors back in the days of Dutch East India Company? Months, probably. That's the biggest evolution in investing. It went from months to weeks to days to hours. Probably in the minutes about 50 years ago, it was in the seconds. How long do you think it takes today for information to get to investors? It's almost instantaneous. Can anybody still have a consistent competitive advantage in getting information faster or better or analyzing properly? I don't think so. There are more professionally managed mutual funds in the U.S. than actual stocks trading on the market. It's not competitive, it's hyper-competitive. And by the time you put in the fees, what research has shown is that over 15 years or so, or 20 years, about 15% of these managers outperform 85, 5 and 6 underperform. So this system is not, in my opinion, where what Gretzky used to say, I try to skate not where the puck used to be. This is where the puck used to be. And this is what Dimensional and the academic community pioneered in the 80s, was a different way to think about it, that instead of analyzing individual companies, the idea was that we want to look not at the company by itself, but the company as part of a larger group, a larger basket of stocks. So in that respect, it's not about loving or hating any one company, but analyzing much broader baskets of stocks. And that's what data and computers allowed us to do. I was trying to explain this to my mother-in-law, and I love her. She's great, but she's more visual. And I told her, when I was in Sydney in May, my friend and I went swimming at Shelley Beach. There's actually there's Shelley Beach and Manly Beach, whatever it is. It's like a half a mile stretch. Nice, warm water. By the way, it's just two of us. It was so cool. Like we were swimming, and we got the whole thing to ourselves. We just missed the memo on the shark sighting, so I don't think we should have been there. But anyway, it was all fine. But at some point, as I was swimming and I had my goggles on, and I looked down, there was a school of fish swimming there. It's all colorful and going left and right. And I looked, and every fish was moving so randomly, up and down, left, right, sideways. And there's no way you can predict how each fish moved. But once we swam a little bit longer, I started to capture and understand the behavior of the entire school of fish with a lot more precision than I could any one fish. And to me, that's kind of what kind of hit me. This is like in investing. We're not trying to predict any one company, any one fish, but the school of fish as a whole. So what Dimensional is advocating is don't love or hate any one company, but rather kind of look at the entire school of fish. Fish by the net, don't fish by the rod. Maybe that's fun to do, but in this day and age, when you have computers and data, understand the behavior of all of them. So the numbers that I showed you here, they all represent the school of fish. And within the school of fish, some fish will be eaten. And there's some companies will die and go away. And they are part of these numbers. They're not leaving them out. When they go away, they're part of it. We lost all the investment. But even with that, you still are above that. So it was a very long-winded answer. But in the 80s, the question was, what about all these large companies and all the small? Are they exactly the same? And it turns out there's something else that matters. Not just that you own the company, but what price do you pay for the company? And the companies that have a low price, they're called value stocks. They tend to do better than the more expensive counterparts called growth. So how much do you pay for $1 of earnings or book value or dividends matters. And the lower price do better. So if you know that value beats growth, small beats large, what's the one part of the market that ought to give you the biggest bang for the buck over the long run? Small value. So if you look at the same, Chris, what's the growth in small value over the same time frame? 72,000. Same dollar, same time frame. So if you wanted to do better than the S&P, which are these large companies, is there a way to do it? Over the long run?
What is it for small cap growth?
What is it? We have it in there. I can tell you, I don't know exactly off the top of my head, but we can look it up. What's the small cap growth?
I have the book.
Oh, you have the book. I don't know what page it is. Yeah. Okay, so
Make sure you get it back.
so if you look at small cap growth, you got large value, you got large growth. Let's see. Yeah, the small cap growth, it doesn't go back to the same time frame. So that's kind of makes it harder to compare.
Small cap growth has been on a tear.
Small cap growth has been on a tear. And that kind of leads me to Sue's point was great to kind of lead me into the last. Small cap growth has been on a tear. So why are you telling me so much about small value when small cap growth lately has been on such a tear? The biggest risk, what do you think the biggest risk? I mean, there are three questions that I get all the time whenever I talk about this small and value. What do you think they are? Why doesn't everybody do it? I've never heard of this. What's the risk, and why not put all my money in small value? Because it seems like it would be intuitive. Here's the risk associated with this, which is the biggest thing, and it comes back to the point that I made earlier. The biggest risk of this strategy is not that you would lose more money, because by the time you package it with large, small, international, all bonds, you're not going to feel a very big difference at all. So it's not about the risk of losing money. It's a much more insidious risk. If I'm sitting here and I'm telling you that small beats large and value beats growth, what's your expectation when you meet next quarter with Dowling folks? Exactly. How do you feel if it doesn't happen? If small growth beats small value, how do you feel? Fired. You want to fire them, right? It's like, why would I want to keep them? But you can tell them, I'll give you another 3 months. You come back after 3 months. Still doesn't work out. How do you feel then? Angry. Upset. You give it a whole year. You say, I'm giving it like a last shot here. I'm giving it the whole year. It didn't work out. What would you do? Fire them. That's the reason that this is not a mainstream strategy. This is exactly what large institutions use, but not investors. Why? Because of what I said earlier. This is not about certainty or guarantees. It's understanding the odds. If you look at a 1 year and you ask, how often do I see small beating outperforming, or how many years, what percentage of the time do I see in any annual, not quarterly, on an annual basis, how often do I see small outperforming or value outperforming? The answer is about 60% of the time in any given year, I'll see that yes, indeed, yes, it plays out the way that I expected. What's the flip side? 4 in 10 years, it doesn't. It's no. Is that trivial, 40%? No, it's quite often. But even if you had 1 year, I know that small might not outperform. I know that value might not outperform. But even if you had 1 year, what part of the market would you think would give you a better shot at outperformance? The 60% or the 40%? And if you give it time, now you give it 5 years, and you say, okay, I'm going to give it 5 years. It's not 1 year, it's 5 years. It goes to about 70%, so it moves up. You get a better shot that you see indeed this happening. But even now, 30% of the time is a no. Even after 5 years, 30% is no. So again, but let me ask, if you saw these odds, which part of the market would you like to emphasize? You could do growth, and you can do small growth or whatever it is, but if you saw these odds, which part would you emphasize? Those 70% or the 30%? There. And that to me, like, you have to acknowledge that even after 5 years, about 1 in 3 you're not going to see it. And we're talking at lunch, we had a little session, and I was telling him my little experience of how do I kind of move this into my own kind of like experience. I'm not a gambler, but I was in Vegas in December. I had a little conference there, and I knew that I might spend a few minutes and I'm not a gambler, by the way, but I'm actually as far away from that. But I do want to donate money, so I thought, why don't I teach myself a little bit? And I'm not a blackjack player. Anybody plays blackjack that knows what they're doing? Nobody? Boy, you guys are, okay, Sue. All right, so if the dealer has a 10, and you have 13 in your hand, should you hit or should you stay? All the pros that I talked to, not the pros, like pros, the people more than I do, they all said you should hit, because if the dealer gets a 4, 5, 6, you're in trouble, you're done. So the odds are much better to hit if you had a 13. What do you think? Make sense? Yeah. I mean, that's at least, well, that's kind of like what I know from my limited knowledge. But let's just say that's the case. What if you played that strategy 4 hands in a row and you busted every time? Should you play your next hand any differently? No. That's kind of what this is all about. The people who get hurt in the strategy is the one that I've tried it for a year, I've tried it for 2 years, it doesn't work, let me try to do something else. The only people who get hurt are the boys who jump out of the middle of the ride. I mean, that's kind of what this is. Like, you know that there'll be years when small growth will do much better than small value. I know that's going to happen. And the only way that I can mitigate this and kind of say, well, I want to be careful about this, is not by putting all my money in small and value, but really kind of saying, what I want to do as a smart investor is pretend this is an ice cube tray. By the way, my daughter doesn't even know what an ice cube tray is. But the one that stick in the freezer and it makes ice. If you hold it level and every cube has the right amount of water, that's sort of like the stock market. What we're saying is, tilt this, take some money, take some water from large and growth and put it down towards small and value. But don't do this. So tilt it to some degree that you still have large, you still have small growth, you still have all these, but it's just a matter of emphasizing different parts of the market. You still have them all. So right now, in a portfolio, and I'm not very intimately familiar with it because each portfolio is custom to you, but I can tell you that by and large, even though in my own portfolio I have a tilt, it's called a tilt, like I tilt this portfolio towards small and value, I emphasize it more, the largest holdings that I have are still large and growth. Because as part of the market, you know, that's what the biggest weight is.
So what does your portfolio look like?
So what does my portfolio look like? So my portfolio, it is interesting because if you had asked me when I was in Santa Barbara, it was very different. The reason I say is that my portfolio right now is invested. I mean, if you want to know, I'll give you the percentage. Right now, I'll give you all my vitals, my Social Security. No, I am 50 years old. I just turned 50. And I plan, based on talking to my advisor and all, I plan of working for another 15 years. That's kind of my plan. So right now, I have a preponderance of my assets in the stock market, and it's a balance between, if you want to know it precisely, it's probably about 65% in U.S., but this is just for my own preference. And I have internationally developed, I have emerging markets. I pretty much own the entire stock market around the world. And the stock market represents about, this is my personal preference, with 75% of my portfolio is in the stock market, 25% is in bonds, just because I'm extremely fortunate to work for this company, Dimensional, which is very stable and it's been around for a long time. I've been there for 16 years, and I have no plans of going anywhere else. So I really feel very comfortable with my paycheck and my stability of my income. So because of that, I plan on building my bond portfolio by the time I retire to be more balanced. But that's kind of where I am today. I basically own U.S. And then when it comes to small and value, I emphasize quite a bit more small and value, both in U.S. and international. But Remember, I'm on the inside, and I know what, I'm not going to pester anybody with this. I kind of manage my own expectations. You got to be careful because quite often people underestimate when they look so different from what they see on the news or they see something else doing better. They do tend to look and say, second guess the strategy. And in my case, I'm fully bought in. I mean, every penny, yes.
So 2 questions. You said you hedge your bets by bonds, international, and what's the third one?
The third one. So that's very good. Thank you so much, Sue, for reminding me. The third one,
I'm not here, like,
I love that he's doing that because
a straight guy or what? So,
it was over the 3 years that since it was a tenure. The tenure meaning like when did he start? So it basically goes back to
it says Trump, 15.7.
yeah, but it's February. His 10 years didn't start last year. It started in 2016.
Oh, okay. Got it. Thank you.
But the third point that's thanks for reminding me. The third point, so bonds, international stocks. The third one is that whenever you see something going up in value, like the market's been going up on the tear or whatever it is, one thing that I think it's useful to do is having an advisor to pay attention. And at certain times, it is wise to trim some gains, take some chips off the table, and then go buy something with a better valuation, something to get you back in line with the balance that you need to have. And that process is called rebalancing. And rebalancing protects a portfolio from being overtaken by one category of stocks or bonds. But it also not only protects you, but it helps you tremendously because in 2008 when the market tanked, what most advisors we worked with did, they would sell the bonds, which had gone up in value, to go buy stocks to get the portfolio back in balance. And that's exactly what you wanted to actually recover from the loss. And that's kind of like the third way to do it. When look at the markets, and at some point you sometimes need to rebalance because if they're not in balance, that could either change the risk or miss the opportunity. So with that, I mean, I think I overstated my welcome. I really appreciate your time here tonight.